I'm shocked as a consultant. Next month is my 5th year running my consultancy. So I'm coming up on my 5th year anniversary.
Congratulations.
And look, the tagline is for our company is granular analysis, strategic direction. And I'm a believer in granular, unbelievably granular.
Oh, I love that. We've got to do a whole podcast just on that one.
Right. And I think, look, I walk into companies today, big, medium, and small, and I'm shocked at the lack of granular analysis where it appears to me that in some cases the senior team is intentionally lying to themselves.
I know. That is, they lie to themselves. That's start getting to the points, the 5 focus. So I'm going to get into the 5 points.
That's my view. Look, I think it's a trend. I think it's a trend that's going to be with us. I think you're going to see other affiliate deals. I think the JV strategies that are going on in the industry are absolutely part of the future. Yep. I'm just not willing to say, okay, game over. It's over now. Just see everything.
Because Rocket did that one. I agree. Right. As good as Rocket is, the market's even so much bigger than them.
And by the way, I'm anxious to see how it comes out because I think it's going to be absolutely a model of the future.
I think so too. And I don't think they spent that much money to buy entity intending to fail. I don't think they're being cavalier about it. I think
about it though. You're getting 50 million leads a month divided by $1.7 billion on a per lead basis is probably cheap.
It's a cheap deal. Exactly. I was going to jokingly say, you know him, what's the gentleman that used to work for you? I'm going to say Brian, who didn't work for you in this industry at some point in time. Yeah. Where you sat in the industry, so we can go on that.
I have that with clients when I'm doing executive search. I have that with clients all the time. Go, do you ever bring anybody who didn't used to work for you? And that's a short list. So
that's a short list. I'm honored to have you here, and I want to get into these 5 areas. The 5 focuses for 25. The first one you talked about, and when we were together in Dallas at the Housing Wire Economic Summit, plugged the Housing Wire. They did a great job on that. I thought they nailed it. It was a really good content. But you said for those of you in the mortgage business and the mortgage sales business, do you know what who your salespeople are calling on? Purchase leads, more importantly, and then why are they calling on them? I dive into that point because I think that was a great start off.
Yeah. So let me just give you a couple of pieces of data very quickly. And by the way, let me just footnote this and say the data I'm about to give you is for 2023, but I will guarantee you that 2024 data is either the same or more concentrated. Okay. The top 1.5% of realtors and real estate teams in 23 accounted for 68% of all sales.
Wow.
The top 2%, 74%. The top 10%, 89%.
So why are you calling on anybody else?
So if your sales force is calling on the bottom 50%, let's just start there. We'll make it easy.
Yeah,
the bottom 50% of realtors in America, the only deals they have, in my opinion, are either friends and family, right? I'm your uncle, so you're giving me the deal kind of thing because you're embarrassed to see me at Thanksgiving if you don't. Or kind of random acts of management, meaning if you roam around, you're bound to trip on a deal. But that's not an annuitant, repetitive business that you can build your business as an originator on because that's the blind squirrel found an occasional nut approach to getting a transaction. And by the way, this concentration to the top, look, you look at Compass, I think they have their challenges, but they got 20,000 agents.
They do, yes.
You look at Place, a company that I know well. They're a tech-enabled prop tech that supports top 1.5% of real estate teams in the U.S. with a tech-enabled platform. Every one of their 4,000 agents that are part of their platform are in the top 1.5%. Right? So if you're calling on the bottom 50, and I'm throwing out some names, there's a lot of services out there. I happen to know Jeff Walton at Ingenious really well. We work together. Again, Jeff used to work for me in a previous life. Great guy, great personal relationship. But there's companies like Ingenious or Reader or others that are out there.
I love Reader.
Where every day, you can know what real estate agents in your market are doing, volume, loan size, sale price size, where their deals are going, why their deals are going there, without ever talking to the agent.
Without ever talking to them, yeah.
Wouldn't that be a better piece of intel? Yes. If you were going to battle? I had a mentor, my first mentor in the mortgage business in the early 80s, when I used to close 1,000 loans a year. My early mentor told me, look, there's 2 types of people in real estate that you should think about calling on. One are the people that are in real estate, and the other are the people who actually sell real estate. And if you want to be a success, call on the people that actually sell real estate not
so
just
funny.
drink coffee and drive around and think about selling real estate.
Yeah.
And if you don't know the difference, so if I was running a Salesforce today, and I've run 10,000 originators in Salesforce in the past, 5,000, some big firms, right? I question the investment in middle management as much as I would have an army of financial analysts with one of those systems providing a profile of every one of my originators every month on where their business is coming from, what is that agent actually doing,
And
where's the rest of that agent's business going, why is it going there, and create a profile to help my sales force. By the way, you should be calling on David Lykken. He's selling 22 pieces of real estate a month. Okay, but he's already got a relationship. So what?
So what?
Right.
Yeah.
Go call on him. There's business there.
Yes.
And so my point being, I hear this from CEOs and heads of production all the time. As long as they're doing $1 million a month, I don't care.
Oh,
You should, because
that's
the
painful
bottom,
to hear that. Yes,
in my
I hear it
opinion,
too.
the bottom 50 or 60% of agents, in my opinion, with the change in the commission rules, this CCP thing coming out, which effectively today protects smaller agencies.
Yes, it does.
You got a lot of change going on around you. And if you're impervious to change, I think that's the definition of going out of business slowly and you don't realize it.
That's exactly.
And
right.
by the way, I think you're being intellectually lazy.
Yep. That's the most important.
Whether it's David Lykken or Brian Hale or somebody,
Yep.
if you're not sure how to do this, call one of us.
Call one of us. Yes, absolutely.
Right.
What you're really hitting on the point one is the business intelligence tools. We have business intelligence tools. I want to give a shout out to our 3 sponsors in this area. Redder being one of them, MMI.
I didn't even know Redder was a sponsor. So
yeah, Redder was a great sponsor. They're one of our newer sponsors. They're thrilled to have them here. And also Jeff Walton, dear friend. We're involved in a mastermind together. And so Ingenious is one of them. There's many of them. But the bottom line is, are you really using it? But the thing is, people have these subscriptions, these business intelligence tools, Brian.
you don't use them.
But they don't use them.
Right. They have one seat that's for the head of production who also doesn't use it.
Who doesn't use it? I know. It's just that's a whole.
I take a $150,000 a year financial analyst and let him or her loose in that database.
Yeah.
And have them look around corners for me and tell me who in each market my people should be calling on. And let us engage the salespeople. Why aren't we? What do we need to do? Is it product? Is it marketing pieces? What is it? Let's go there.
Which goes into point number 2. You talked on stage about closing leads you already have. That was Joe Stump used to have. Remember Joe Stump? You guys at Countrywide used him. Joe had by referral only. He said if you're in the business for 2 years to have a reasonable amount of volume, you should never have to make another sales call because you should have so much referral business. Is that what you're referring to here?
That's part of it. I would say if you were looking at the pie of leads, what you just described is a slice of that pie. What I'm actually talking about is, look, I see this happening in companies all the time. Sales forces are banging on the company, buy me more leads, buy me more leads, right? The recruiting deal is, we'll give you leads. Okay, first of all, if as a company, you're giving out leads free and you're still paying $1.25 in commission or $1.40 or whatever, I don't get what you're doing. It's up to you. It's your money. I got it. But I think it's foolish because what I think you pay a commission for, I can teach a 3rd grader to take an application. That's not what we pay commissions for, in my opinion. You pay commissions to get deals, to get revenue you can't otherwise get for yourself. And so if you've already got the lead, but here's the deal. I have a simple view, and I got to give others this credit for this saying. You want to make more money faster in the mortgage business, close more of the leads you already have.
Yep.
Before you go looking for more leads.
And the word is, one of the words you used there was convert.
Yes,
convert more leads. And so when you close more leads, convert it. So the convert comes before the close. What are some tips on the converting that needs to happen?
Number 1, so I just had, a couple of weeks ago, I had Jeremy Forcier.
Oh, yeah.
From Cross Country Mortgage up in Sonoma, California, who has this down to a science. And if look, as David, I run the weekly Roadmap podcast every Friday at 9 a.m. Pacific. And we had Jeremy on there, and we keep all that in the community. So if you're a subscriber, you can watch the same video of Jeremy 14 times in a row to even embed it. And what Jeremy did in that video, 40 minutes, he showed you the bike. He showed you how to get on the bike. He showed you how to pedal the bike. And I tell you, you get on the bike and pedal that bike the way he describes it and use the phraseology he uses, you too can make another $600,000 in commissions. That's the short version. The couple of things that came down to. Number 1, measuring your results. When I was on that podcast
That's point
that day,
number 3. That's point number 3 that you hit on the stage.
Because it crosses, it's actually point number 1 as well.
Yeah, they all tie together.
When he was being interviewed by me, I asked him what his credit bureau pull to funding conversion rate. He glanced his eyes to the left to another screen, and he told me to the decimal point.
Wow.
Okay?
He studies it, and he has it in front of his eyes all the time.
He is accepted as a religion that he is the CEO of his origination business.
Good.
And that's a critical piece in my view.
Well,
a lot of people want to rely on my company doesn't do this, my company doesn't do that. You own your business as an originator.
Yep.
And so he measures everything. He measures the conversion rate of his team. He measures the conversion rate of, he has 17 originators working for him in his branch. He measures his own conversion rate and measures and shows the rest of his team. He measures theirs against his. He can tell you lead to credit bureau to app, to closing, repeat customer. So measurement, knowing what's actually happening with your leads and holding yourself accountable, or get an accountability partner that holds you accountable. That's number one. Number two, his phraseology, just a brilliant phrase that he has. When he gets on he meets with almost every customer personally. Doesn't have his team. He doesn't interject his team. He doesn't send you a 1003 via link. He doesn't do any of that BS. He gets you on a Zoom call like this and says, David, what's your greatest fear in doing this transaction and buying your next home or in buying your first home, depending on the client, right? Then shuts up.
And listens.
And the customer just reveals everything.
Yep.
And if you're a salesperson, if you don't understand the science of selling, that what you're looking for are targets in the course of the conversation, in mirroring back to the client or to the customer what you just heard, giving them a solution, a solve for their fears, especially first-time home buyers. I remember when I bought my first house, and that's how I got in the mortgage business. That's how I got in. The guy that took my app ended up hiring me into the mortgage business. And so everybody's fearful. I bought a lot of real estate in my life. You still don't know until the deal's approved. There's still some level of anxiety. Or in my case, I was always moving my family to a different city. So there's
all the
tons of anxiety in the whole family. So I think this concept of converting, having a process. He has a defined measurement. He has a defined set of scripts. He has a defined follow-up program for the leads he doesn't convert. And he has a very regimented, what are we going to do in 2 weeks? What are we going to do in a month? What are we going to do 2 months from now? And they stay in follow-up forever. Number of leads he gets out of that database that come back and create a mortgage app for him, it's unbelievable. So if you're going to run a business, you got to know who you're chasing. You got to know the leads that are coming in. How did you do? How are you measuring? Is your lead conversion dropping or improving? And then when he finds these phrases that work, he repeats them over. He doesn't make it up each time. I had Sean Bonosian on a month ago. You hear the exact same thing from him. You hear it from Shayla Gifford. You hear it from all these folks. It's the same. There's a guy by the name of Joe Massey who works Castle and Cook in Denver.
Yeah.
Killer guy. He came on my podcast. Same thing. Here's the bike. Here's how you get on. Here's how you pedal the bike. You do that. There's $600,000 worth of commissions in Joe Massey's ideas, right?
Yep. You're just hitting on the point so much. And I want to get on to another point, but I can't underscore this. If you will send me a link of Jeremy's interview that you did, we'll put it in the show notes so people can go click on it, make it real easy, listeners. So if you're listening to this, go to our website, look at on lending, and go to this interview. You'll see a link to that interview.
Yeah. By the way, I'm back to this magic secret sauce in the mortgage business. Gets up early, works out, works his ass off, does the same thing over and over again, wash, rinse, repeat.
What's so fun about you and I, just before we jumped out, we both were working out this morning before we got onto this interview. That's what we do.
You guys have to.
Yeah. One of the things you talked about, which is point number 4, was most people have focused adequately or extensively on expense control during this downturn, but they have not focused sufficiently on revenue and margin management. Boy, when I heard you say that, I wanted to stand up and scream, amen, brother.
You should have. So let me give you just a couple more data points.
Yeah.
There's 374 MSAs in the United States, right? The U.S. government metropolitan statistical areas. Right. If you start breaking them down by census tracts, or you start combining, there's 4 MSAs in the greater New York City area, right? Because of the dense population. Same thing with LA, right? So there's about 650 markets, distinct markets in the United States. Each one of those markets have a distinct competitor set. Each one of those markets has distinct demographics.
Yep.
Loan size, sales price size, the employment base? Is it high tech with a lot of stock options kind of stuff, or is it manufacturing, machine tool industry in Milwaukee, Wisconsin, where I used to live? And so recognizing that each of those 650 markets are unique. Now, is G rate or rate everywhere? Probably. Wells Fargo everywhere? Yep, probably. There's some lenders at Rocket everywhere. Got it. Okay. But you go to Tulsa, Oklahoma, and the Bank of Oklahoma is pretty damn tough as a competitor. You go up to Oregon and the Nike Credit Union. Unbelievably tough competitor, tough. Right? In the space, right? They're very low price, all good. So if you price one price nationwide, I will guarantee you as I'm sitting here, you are too high, too fat in about 48% of the markets. You're too low, meaning you're leaving revenue on the table in another 48%. And in 2%, you're dead on by sheer luck.
Sheer luck.
And by
so
the way,
true. It's the closing your eyes and throwing the dart. And
so part of this comes down to competitive analysis and data.
Intelligence.
I'm back to data, intelligence. One, to know who your key top 10 competitors are in that market and how they're pricing daily relative to you.
Yep.
People can disagree with me on this. I always took a position that I wanted to be the bottom of the top third in terms of best price, right?
Yeah, best price, yeah.
But I also went over and looked at my fees. And if my fees, my cash fees, were $300 per loan lower than the mean in that market, I believed I could raise my cash fees. And particularly if I look in some past lives, I've had some pretty dominant market share.
You have a huge dominant
in certain markets, right?
Yeah.
So if you have dominant market share, I believe you can price at 110 or 120% of the mean and still get your share. And so who hates that? Any originator listening to this podcast is going to go kill Brian Hale. That's a bad idea, right? So my deal with originators has always been, look, David, you're an originator working for me. I want to raise my cash fees $1. Do you think that's going to screw you up? No. $2? No. Let me know when it hurts. And so part of it is take the move, take the revenue, knowing you're going to discount some of it. Yep. So that maybe somebody waives a half a fee or the whole fee on some loan or whatever the case may be, but you still end up with 80% of the move.
Yes.
That drops right to the bottom line.
Drops right into the bottom.
Right?
Exactly right.
Same thing with your margins on your loans. So it's not just geographic, loan size, FICO tranche, product type. There was a day at Stearns when I first went to Stearns Lending in wholesale. We were 2 times the density of the GSEs on investor loans.
Really?
I didn't want to be 2 times the density of investor loans.
I understand.
We were like 20. Fannie was running like 11 nationally and 13% in the West Coast. So I added 100 basis points of revenue. My sales force wanted to kill me, firebomb my car, whatever. We quickly brought it down to right in the slot. Because I tell you what, you want to get in trouble with the GSEs, be an outlier on that kind of stuff. I woke up one day and we were the price king of 620 FICO VA refis.
Wow.
I don't think I want to be the price king of 620 FICO VA refis, particularly now. And so you have to know what's going on at a granular level. You have to look at it daily. So Louis, who used to be my margin guy, when I was there, then runs the KB JV now.
Yep.
He lives in Dallas. I live West Coast. 5 o'clock in the morning, we're on the phone talking about he'd recommend 40 different moves on a day.
Wow. Wow.
And we were publishing hundreds of thousands of price points. Why? We had retail, wholesale, consumer direct, correspondent, and joint venture. Every one of those business models is different. Every one of those correspondent lenders are different. Every broker is different. Every retail branch is living in a different geography, right? So how can you possibly think that one size fits all? And there's a very specific protocol and mechanic. I'm sure I could help any company set that up. Look, I have to say, and I'm not pitching, I don't have a deal with these guys. Poly, as an example, has a piece of technology that'll help a company do that in a heartbeat, right, in the process. And become much more granular. I can almost, and I'm not going to say guarantee on a public podcast, I can almost guarantee anybody, I can certainly raise your revenue by 10 basis points, probably closer to 25, without changing your volume. And to think about it, David,
That
right?
is
The
in this
average
market.
mortgage company in the fourth quarter lost money, 4 basis points.
Yep.
In the third quarter, they made 18, right? According to the MBA data. So if you improve your bottom line by 10 basis points, that's an 80% improvement in your profitability, right? And if you're doing 7 billion or 1 billion or 20
Yep.
billion, that's like real money.
Yep.
And so people go, that's really hard. And is it fair? Here's the other piece, and I want to put this admonition out. You also simultaneously have to have a very diligent fair lending analysis process.
That's the biggest thing. That's because many people get afraid.
Disparate pricing.
Yeah, disparate pricing. That's the number one thing people.
But remember, disparate pricing is measured on similarly situated borrowers.
Right. Which
And
goes
so-
back into details. Are you able to come up with an argument, put forth an argument on the details?
And or are you able to monitor your own pricing so you can identify people
Exactly
who are
right.
pricing discriminately
Yep.
and stop them,
Exactly.
fire
right.
them,
Exactly.
cut them off if they're a broker. If you find, and I've had them in my businesses before, where we did our own internal analysis, or we brought in Charles River to take a look on a quarterly basis, and we identified people who were clearly pricing based on race. Okay, so you get one strike. We'll counsel you. We'll change your comp. We'll fix this. And by the way, if you keep doing it, bang. And I had a wall of scalps.
Yep.
So if a regulator came in, and I went through 3 full-blown CFPB audits, like 14 weeks
Oh my.
with 15 auditors, right? We never got it. We were fine because I could show whenever we identified a problem, we fixed it. And some of that, we fixed it by cutting off the broker or cutting off the
Which goes to the
rep.
scalps on the wall.
Exactly.
There's nothing more convincing.
And
We had that.
what we effectively were saying is we'll forego revenue to be right, because I do believe that people have the right to be treated fairly. And oh, by the way, it's a funny little thing. It's the federal law.
You're hitting on so many good points. We can spend a whole podcast on each one of these. I want to get to the fifth one, which is you're talking about 2025 will continue to be a very difficult year. There's a lot of optimism that we're going to see interest rates falling. We had some recent trends I'm looking at right now. We saw that reversal has happened here.
Yeah,
this
we're
week.
back up at 435 this morning.
Yeah, we're back up. So I'm looking at this. I'm going, okay. So your perspective on why it's going to continue to be a difficult year this year.
Yeah, one, because I don't believe hardly any of the forecasts. I think some of the forecasts that I see, particularly coming out of the GSEs, I think are politically motivated. You can't be owned by the government and not be tinged by whatever the administration, whichever administration is saying, and it's all blue sky, it's going to be great. I heard somewhere that we thought we'd get back to over 2 trillion in originations, over 5 million in home sales. Bullshit. Forgive me, for your audience.
No,
I think we're going to struggle to get back to 4 million in sales, right? In a more normalized year is 5.5 or 5.7 million in sales. Just show me what the underlying argument is. Yes, listings are up, but mortgage rates are not down sufficiently. I believe for the market to begin to normalize, we need a 5 handle on the front end of a 30-year fixed rate mortgage.
Yep.
Whether it's 5 3/4 or 5 7/8 or 5.5. We need a 5 to really push buyers off the market. Now, that said, I think buyers are beginning to normalize to current interest rates. You see it already, right?
Yep.
The home builders, if you just look at the home builders, they're all offering 4.99, 5 1/4, 5.99 kind of forward commitment money.
Forward commitment, yep.
And they sell everything they put in the air. They could build a lean-to with a 5-gallon pail for a bathroom, and they could sell it, right? And so you look at that, and what you know is the demand is there. Millennials, I have 2 millennial sons. They're getting married. They're starting a family. They all delayed. That generation delayed getting married. They delayed having kids, right? A lot of fun. Let's have some experiences. I'm all in. They delayed getting married. But once they get married and have a family, they're the exact same as the boomers like us. I want a nice house in a good neighborhood with a good school.
Yep.
And by the way, there's a tsunami of millennials and Gen Zs who are going to do the exact same thing. So the future is unbelievably bright.
Yes.
I just think 25 will look a lot like 23 with one caveat. And that's some existential event, right? A significant recession, which I believe and I'm not taking a political view here. I think the administration is trying to push us in that direction because I think the administration knows they cannot bend Chair Powell. They're not going to make him do anything. But if it goes into a recession, he's going to have to react. So it's a ricochet shot to make the action happen, right?
Yep.
Secondly, I think there's a sense that if you can lower oil prices, you bring inflation down, good for rates. I believe that to be true. And I think the administration, if you just look at West Texas Intermediate crude trading at $66 a barrel or whatever, they've got the Saudis to pump more and the OPEC. And if you bring Russian oil back on the market, if you solve the Ukraine thing, I think all of those things can be net positive for rates in the second half. But you know this, David, because you've been doing this a long time. Loan apps that you take in the third quarter or the beginning of the fourth quarter, the cash doesn't actually show up on your P&L until the first quarter of 26.
Yep. Exactly
right? Because you got to process it, close it, fix it, ship it, get it bought, right?
Yep.
There's an after the fact action, right?
Yep.
So I think my own 2 cents is that I think the second half likely will see lower rates, but that's not terribly different than 24, right? Remember, from like July through until the Fed cut the rates the first time, we saw declining rates in anticipation of the Fed cut, and then we lost 100 basis points because the market began to think, wait a minute, the Fed overreacted.
That's right.
And the Fed can control the short end, but they can't do anything about the long end.
That's right.
The only thing you can do there is make unemployment worse and bring inflation down. The Fed will act, and you'll see bond prices settle if inflation. Big number on Friday. This coming Friday is PCE, right? The Personal Consumption Expenditure Index. That's the Fed's favorite number. Will it be interesting to see what happens there? The worst thing that can happen is stagflation. You and I lived through that back in the 70s, where you have a recession and inflation simultaneously, right? Yeah. That's a nightmare. I hope that doesn't happen, but I think there's a chance. And I also think there's a 20 to 30% chance that rates go up in the second half.
Wow.
For one simple reason. You have unprecedented deficits that have to be funded. And so whenever the Fed pushes Treasury bonds into the market, it crowds out MBS at some level, right, in the process. So there's a consumption issue of Treasury bonds and mortgage-backed securities. If you have a world, any kind of war, if you have any kind of, we saw it with the pandemic, if you had some existential world event, you could see rates drop in a hurry. But that, we saw it in 20 and 21. It's a short-term phenomenon that eventually snaps back.
Yep.
And so I think we could see, look, there's one last piece, and I know you track this as well. You know that the spread between 10-year treasuries and 30-year fixed mortgage rates historically has been 150 to 175 basis points, right, up and down, but pretty consistent. It got up north of 300 just a couple months ago.
I know.
It's now down in the mid-twos. And that, I believe, is a function of 2 things. Bond buyers are not sure inflation's dead yet, so they're hedging. They want to get paid now.
Exactly.
Secondly, they believe that these mortgage backs, if you're buying a 7% mortgage today in a security and rates drop into the mid-5s, what's going to happen to that loan? It's going to refi.
Yeah.
So you shorten up the cash flow calculation, so now they want to get paid more on the front end with a bigger yield now as a hedge to that. So we have to get to normalized rates before that spread collapses back to normal. If the spread was normal today, you'd be about 6% 30-year fixed rate mortgages today without the 10-year improving a lick, right? And so I think we have to take uncertainty. And look, there's a lot of uncertainty. And again, I'm not being political here. Nobody knows what April 2 is going to hold with the tariffs. We saw different news yesterday compared to a week ago. Yep. So whether this is strategy or not, the short version is nobody knows the outcome. Mass deportation could raise labor costs across the country, could also spike the cost of food. I can tell you that 40% of what you guys eat you live in Texas, correct? Yeah, 40% of what you eat doesn't come from Texas.
No.
It comes from the Central Valley of California or Mexico. You start cutting that off or tariffing it, your cost of food's going up. I don't care who you are. And oh, by the way, all you guys in Texas can drive out here and pick your own strawberries. There's not going to be anybody left to do it.
There's no one left to do it. Exactly.
Right. Either been deported or they're fearful to go to work, right? Because somebody in their family may not be legal. And so there's a lot of uncertainty. The Fed has immense funding to get done. So there's a chance rates go up. We saw it. We were 421 10 days ago. We're 435 today on the 10-year.
Yep.
So it's not going to be flat. I don't believe 5 million home sales happen. I don't believe there's a big refi boom, and if there is, it's a boomlet like you and I have lived through many times in our life that lasts 5-6 months and then dissipates. It's not going to be 20 and 21, and those who are hoping for it are going to be disappointed. I do think 26 and the next 5 or 10 years in the mortgage and real estate business, once we get all this change sorted out, I think the future is unbelievably bright. I'm bullish on the business. And oh, by the way, there's 100,000 fewer originators competing with you.
I know.
That have gone away.
The macro version of this story is very positive, very bullish.
Yes.
We have 2025. I was really encouraged by you saying, I'm sharing that because I'm saying I was encouraged, never encouraged by difficulty, but difficulty makes us stronger. And difficulty puts us in a position where we're not taking for granted, making stupid moves on hypothetical optimism. And we got to stick with the facts, which goes back to so many of your points. Brian, you bring out excellent points. You did
data, analysis, understanding whether you're the CEO of a mortgage company, a head of production, or a rep. Manage your business as if you're the CEO. Know what your data. Almost all of the answers in the mortgage business are in the math.
Yep.
And if you don't know your math, you are shooting in the dark. You're wandering in the desert. You're a blind squirrel looking for an occasional nut, and you're lucky. And when people's businesses, I had a guy one time, a long time ago, David, and this is back in the 80s, when I first started running Texas as part of my oversight. I had a guy drive me around Houston and show me all the places that mortgage companies and savings and loans used to be. And some of those guys, just go back to 1990, go back to 2000, and realize all the top 10 names that no longer exist.
I remember I ran a mortgage company in San Antonio back in 86, 87, and you could hear the mailman coming because everyone mailing their keys into their condos that they bought in Midland or the homes they bought in the oil patches because they're foreclosed. They said, don't bother. We could literally hear the kids.
My 43 years of being in the mortgage business, by the way, I have a simple view on that. I told an interviewer the other day this quick story. My wife has often said to me, why don't you do something else? Because this mortgage business is a little crazy. And I was like, what else? That's all I know. I'm a social criminologist by education, so it's not like I'm going to go out. I was born and raised to be a prison guard in the state of New York.
Oh,
and that doesn't provide me
managing production. You maybe have been.
Exactly. I always tell people that doesn't sound like the right education for the mortgage business. You may not fully understand the mortgage business. Right. I might have exactly the right education. But that said, look, I believe. I don't know if I believe in reincarnation or not, but here's what I think happened in my life, in a previous life. I must have wiped out 1 or 2 civilizations. And the gods came together and said, what are the penance for wiping out 2 civilizations? I know. Let's sentence him to be a mortgage banker for 40 plus years. That's a penance, right?
That's a penance.
And so I have, by the way, a little humor on the side. The mortgage business has been remarkably good to Brian Hale and his family for 40 plus years. And I'm a bullish.
It's because you've done these things. You've operated by principles, just solid business principles, Brian.
Yeah.
And I applaud you for it. And I'm just so grateful to have you on here. We could talk, a couple old guys like us get on here, talk about the mortgage business. We could go literally all day. We have the stories.
By the way, I think there's a bunch of young folks who listen to your podcast who will go, why the hell should I listen to a couple of gray hairs talk about the old days? This isn't the old days. No. There are these basic principles that were true then. The tools are different. I think AI is going to have a huge impact on our business. I think a lot of things. Here's my one piece. I'll leave you with this last metaphor. I use it all the time. I use it in my podcast every Friday. I'm a big fan of the metaphor about Tyrannosaurus Rex. If you think about T-Rex, for 300 million years, T-Rex ruled the world. They were the top of the food chain, right? They ate what they wanted to eat. They made little T-Rexes. Life was pretty good. Somebody from corporate headquarters showed up. They ate them. It was a good deal, right?
Yeah.
Have you seen one lately?
No.
And the answer, of course, is no, because they went extinct. And most paleontologists will tell you some existential event happened in the world. They think a meteor created like a nuclear winter, which killed off all the animals that T-Rex used to eat because there was no leafy matter for those animals to eat. Those were the leaf eaters, and T-Rex ate the leaf eaters. So T-Rex had one problem, one besides the fact short arms, had a brain the size of a walnut, and really wasn't very adaptable to change. Does that sound familiar?
Oh, boy. Yes,
right?
That's so true.
So if you're not adaptable to change, if you don't recognize that change is everywhere, just look at the last 2 years. Look at the last 4 months.
I know.
See if PB's kind of gone away. Pulte just wiped out the entire senior team at Freddie, wiped out the boards of directors, killed a couple of programs, right? If you don't think change is around you. And secondly, that it's going to accelerate going forward, you're kidding yourself. Absolutely. And so my question always is when I finish a speech to a bunch of salespeople is, are you adapting to change? Are you embracing the change around you? Or are you stuck with this? I'm just going to keep doing what I've been doing for the last 20 years and hope it works out. And if you're not, I think you're T-Rex in search of a tar pit.
Yep, that's exactly right. A T-Rex in search of a tar pit.
Don't be that guy.
Don't be that guy.
Now.
And you don't have to be. The reality is you don't have to be. It is coming. Change is coming. Oh, man, I've got to have you back, Brian. This is such a fun discussion.
Be glad to do it anytime, David, and I'm going to extend the invite to you the other way as well.
Oh, good.
And
I'm looking forward to that. I always enjoy sitting around. I love talking with intelligent people that have a good analysis, that challenge the heck and boldly speak out. I think.
Look, I would tell you, if you ask my wife, Pamela, she's a therapist here in Orange County, California, right? So we only have one rule, no therapy at home. But if you asked her, she would tell you that all of my filters broke about 5-6 years ago, and I haven't endeavored to fix them. And
I think that it's interesting you've gotten into consulting 5 or 6 years ago. So it's successful.
Yeah, it's the same business. But what I always tell people, ask me all the time, why are you still working? First of all, I do what I want to do. I fly fish. My wife and I are going to Tuscany to celebrate our 40th wedding anniversary, and we're going to Africa later in the year.
Awesome.
If I have you know this, if you have a cell phone and a laptop or an iPad, you're in business anywhere in the world. Yep. And so that's part of it. But really, what I enjoy more than anything is working on really complicated things. Why I like to do M&A. I never set up my practice to do M&A, by the way. I fell into it. I closed 4 deals in the fourth quarter last year. I'm working on a couple more right now. And by the way, if you're thinking about having a strategic conversation about your company, call me, right? Yeah. With that said, I like working on complicated things with people I like. And that's my filter for client acquisition. And I have a little clause in my consulting agreement that I refer to as the asshole clause, which is that and it's mutual, by the way, but if at any point you and I, if we're clients together, we believe the other guy is an ass, we're done.
We're done.
Because life is short.
I put all my contracts are month to month.
Yeah.
For that very reason.
Well, I don't do that, but I would just say this, that I've only ever taken out one client, and two, the other thing I always ask new clients is when we're working together for these next several months, would you like me to tell you the truth, or would you prefer I lie to you?
Yep.
And people go, of course we want the truth. You sure?
Yeah. Sure.
Are you sure? Really sure? Could you send me an email to that effect, would you please? Yeah. So that 4 months from now, when I tell you your sister-in-law should be terminated, because they can't handle that role anymore, or your brother-in-law, or your first cousin, or your best friend from high school, or whatever the hell it is. Look, and you can tell me to go to hell. I'm just the outside third-party guy, right? So feel free to deny my advice to you. At the same time, I'm going to tell you as I see it, and it's how I ended up in the executive placement side of my practice. Because in about 80% of the situations, the problem I'm brought in for is diagnosable, resolvable, a plan can be built, but oftentimes the person running that particular function or unit or division or whatever is in fact the problem, not because they're a bad person, generally they're good people, but the function may have outgrown them. Maybe now they're a 2-chair or a 3-chair, but they're no longer a 1-chair. Yep. And you're not going to fix your problem until you fix the 1-chair. Yep. You talked about, right at the beginning, you talked about Rocket. You have to, if you can't execute,
you're not executing
everything else. There's Todd Duncan.
One question on that. I heard one person say they have a rule that I move you up or I move you out. Is it possible, you're talking 1, 2, 3 chairs, do you see it successful where people can step down to a 3rd chair?
I've seen it work, but
seldomly. Yeah.
Here's how it works. I can tell you because I did this at Stearns. I brought in a lot of outside talent. There was this kind of a derisive term that you became a FOB, friend of Brian. Here's the funny part. I don't have any friends. I'm not a particularly social guy. What I brought in were really competent people who could deliver, who had been to the top of the mountain several times. They knew the path. Yep. And I'm not looking for a guy that's got a shiny new compass and a brand new map. I'm looking for somebody the map is worn out, the compass is dented up from having made the trek several times. And the way it works is that you have to be very thoughtful on the selection, because if the person you bring in over the top demonstrates competency, knowledge, sensitivity to the person who got stepped down, treats them like a human, doesn't come in with some arrogant asshole type attitude, it'll work. Not always, but it has a far better chance of working. If the person you top them with is incompetent or looks like some kind of special friendship deal, then you piss off the whole world and nothing works.
That's right.
So, this is, again, the shocking revelation on the Lykken show this morning. Competent leadership improves your business.
And when you work your ass off.
Write that down, because there's a revelation that you've never heard before, right? Or never recognized.
Brian, thanks so much for being here. What a treat. Can't wait to have you back.
David, I can't thank you enough for the invitation. I look forward to talking to you again soon. And if I can help anytime, don't hesitate to ask.
I'll be asking. Thank you. Wow. That interview, I got to tell you, I could have talked to Brian all day. We kept talking after we shut off the microphone. We're going to have him back. This is a teaser. Spoiler alert. We're going to have Brian back. We're talking about lessons learned from the Countrywide Days. There's so much leadership, folks, that we've got to pull out of guys like Brian Hale. Just such a good interview. I want to say a special thank you to our sponsors, Byte Software, Finastra, Angel AI, True, Candid, Mortgage Bankers Association of America, Lenders One, the Mortgage Collaborative, Mobility, MMI, Modex, Redder, and Knowledge Coop. Listeners, share this interview that I just did with Brian with everybody. It's such an important one. And I look forward to having you back here next week. Appreciate you as listeners. Thank you so much. Have a great day.
You've been listening to Lykken on Lending. Our passion is to bring you the latest insights, trends, and updates from the world of mortgages. So on this show, if you're a seasoned industry veteran or just getting started, it's your go-to source for all things mortgage. We hope you've enjoyed the show. We'll be back soon. Take care, and we'll see you next time on Lykken on Lending.